All the content on this channel is for education or entertainment purposes only. It does not constitute financial advice. Always remember to conduct your own research. So in today's video, I wanted to run through the ultimate income pie. We have recently just done an update on the monthly income pie, and I wanted to run through some of the changes and some of the things that I think have been happening in the market. And I'm going to show you exactly why I have made these changes to the monthly income pie. I think a lot of these assets now are getting better, and income's strategy seems to be working as intended. We've seen a lot of positivity. A lot of the total returns are actually doing very well, which I'm going to be honest with you, I didn't think income shares as a strategy would work this well. And I really think that 25% uncapped equity is really helping us right now. And I'm just really glad to see it happening. I think it's been a long time coming, and I think if income shares really nail this strategy, this could be exactly what we've been hoping for all this time. So this is the ultimate monthly income pie so far. We've had 1.8k pie copiers. There's been 120k views so far. So we'll just run in exactly what the monthly income pie is. The ultimate monthly income pie is designed to deliver monthly dividends while remaining diversified across income funds, cover call strategies, commodities, and high yield ETPs. It uses a rule-based system used to add investments with updates shared monthly in my videos so you can all follow along. Why follow this pie? It aims to generate a steady monthly income stream to invest or withdraw. So with that being said, this is my portfolio, so please, this is not financial advice, it's for educational purposes only. Always do your own research before investing in any products. I am just a guy on YouTube. But it does aim to generate a steady monthly income stream to reinvest or withdraw. As if you watch my portfolio reviews, I do want to make sure that this pie is withdrawable so that my portfolio can pay my bills every month. That is the aim of my portfolio. I'm looking to draw £2,000 a month away from that. If it's not possible to withdraw away, then it seems rather pointless to me, because that's the aim of my portfolio. And my portfolio is the ultimate income pie. So this combines ETPs, income funds, and lower risk dividend payers for long-term compounding, such as diversified across equities, bonds, income trust, and alternative assets. Just a little disclaimer again, guys, this is not financial advice. Always do your own research. We have 14 assets right now. I do want to make this 20 long-term. We just don't have enough monthly assets in here. The only thing that is not monthly is JGGI. Unfortunately, that is quarterly, but apart from that, all looking well so far. Let's run through the update then. So we've got JGGI, it's at 13% allocation. This is a very strong asset. If we just jump to Snowball and just look at JGGI, the total return over 5 years is nearly 90%. It pays around a 4% dividend every year, increasing its dividend. The 5-year growth rate is nearly 12%. So that just says it all. Very strong asset, really good dividend grower. I think JGGI would be perfect in anyone's portfolio. So then we have SMIF, which is Smith Select Monthly Income Fund. 10% allocation towards this. I do want to lower this to 5% when some more assets come out in October. We have 2 new funds coming in October. Once we get a bit of data on those, I think those could be added to the portfolio long term. Just waiting to see exactly what's going off with those. Like I said, I do want 20 assets altogether. Around about a 5% allocation each, give or take the risk on those assets. So next up we have YMAP, which is the Big Tech Option Income Fund by YieldMax. So far, this has done pretty well. So it's been out since March this year, and so far we have got a 18.43% total return on YMAP. So this pays monthly, 24% yield, looking good so far. So we'll just look at Smith. The reason I picked this is for its consistent dividend. It's consistently paid for years and years, And if you just look, since we had the drop in the market in 2022, it has been growing. The performance is 46% over 5 year, and it's done nearly 11% this year alone. So this is the reason why I have added it, monthly payer. Also, the dividend growth rate is 3%. It's been growing its dividend over the last couple of years. So it's been very good on the dividend side of things, very consistent. If we look, 0.05 payout monthly, very consistently, with some extra payments some months. So this is the reason why I picked Smith. So next up, we have MAGD, which is the Income Shares Magnificent 7 Options ETP. So as you can see, so far since the new funds come out in July, let's have a look at the start date, 30th of July. So this is up 18.53% on performance, and it's up 40% on price alone. So due to that 25% uncapped assets inside these ETPs now, as before we didn't have any equity, I think this is doing rather well. All of Income Shares as products seem to be doing well since we've had the strategy change. So this is the reason I'm adding this. I would love to know your thoughts in the comments. Do you think Income Shares' new strategy is working or not? Let me know below. But this is the reason why I've added them into the baskets. With this being said, I would rather have the Mag 7 basket than the single stocks in there. So I've swapped it for the likes of the Mag 7 single stock ETPs for the Mag 7 basket, as baskets are more stable long term, as we've seen with a lot of the single stock products this year. Next up, we have FEPG, which is the Premium Income Innovation Tech by Rec Shares. So FEPG is up nearly 11%. Came out in July again, as we can see, increasing. And also on price performance alone, it's up 6%. So we've had growth in the NAV. And again, we've got a 25-26% yield paying every month. These are the kind of assets that we want. We want to see the growth of the NAV, even no matter how small it is, as long as it's either stable or we see it going up. This is exactly what we want to see. These kind of products that are paying a yield with some growth in the NAV. I think these are the sweet spot, the 20-30% yielders, in my personal opinion. So that's FEPG. Next up, we have Main Street Capital. We all know Main Street Capital is an absolutely brilliant stock. So as we can see, look, price performance on the 5 year, 164%, 37% on the 1 year. It's just amazing. It doesn't matter how much this stock is at a premium, it just seems to go up. I don't think there's another BDC like this. I think this is one of the only BDCs that performs in this way, and it's 100% my favorite BDC of all time. So I've never mind paying a premium. Every time someone's told me I'm paying too much for Main Street Capital, it's gone up after and proved them wrong. There's not many times where this stock has actually dipped. Maybe a couple of percentage points and then it's back up, unless there's a market downturn, of course. But if we look there, that massive downturn we had at the beginning of the year, it dropped. But just look how it's recovered. 36% on the 1 year. And then if you look year to date, it's up 15%, including that big dip. What a great BDC. Next up, we have the PIMCO US short-term high-yield corporate bond. So this is the same bond as was in before, SSHY, but this one is hedged towards the pound. And I'm going to show you exactly what's happened this year. So we've got SSHY, which is not hedged towards the pound. And look at the price performance, -6%. The dividends are only just covering. As before, over the last couple of years, this has performed pretty well. So this has surprised me a little bit. I've been a big fan of PIMCO bonds for many years. This hasn't performed that good this year. But then if we look at STHS, this is hedged towards the pound. So it's actually gone up by 7% this year. And look, we had that dip and we've actually recovered. We're back up. So again, I think this is a great pick to swap out for the SSHY bond fund, as it is hedged. Next up, we have JGGI. So I've got a bit of a love-hate relationship with JGGI. It seems to only go up when the market goes down and vice versa. So I think I would like to swap this out at some point when some more assets become available to the market. But there isn't that many assets that actually hit the criteria right now. And this is actually getting total return, so it's not that bad a scenario, but I would like to swap it out at some point. It's a good hedge in someone's portfolio for when the market goes down, I think. So if we look at the 1 year, we're up 4%, but on price action, we're still down 3.85%. So we are only up because of the dividends on the 1 year. Yeah, this is in there right now, but I wouldn't be surprised if I do take it out at some point when some better funds come along at some point this year or next year. And then GLDE, which is the gold ETP by income shares. So this one is up 33% on performance on total return, 6% dividend yield. It's up 25% on price return. So this is the reason why gold ETP is in here. It's been a great fund so far. And I know gold's been on an absolute steam train lately, but I can only see this doing well long term. Next up, we have JEPI, which is the JP Morgan US Equity Premium Income ETF. Now the JEPIs, I haven't had a look at in a long time. So let's have a quick look. JEIP, which is the pounds version, let's go year to date. So price action, we're down 8.52%. The JP Morgan seem to get hit pretty hard in these downturns. And when we've got the likes of the REC shares coming over, the yield maxes coming over, I think JP Morgans are going to be left in the dust when the better funds come over. But unfortunately in the UK right now, we haven't got that many funds compared to the US counterparties. We're going to have to use them for now. Right now, minus 3.34% on total return. They do need a bit more time to recover, I think, but I'm really hoping they do turn around and it does start performing pretty well. Otherwise, we're going to have to start looking at some other assets, unfortunately, rather than the JP Morgans, but it is what it is right now. So JEPQ is next. JP Morgan Nasdaq Equity Premium Income. Let's have a look how this one's been doing. Year to date, the performance is up 0.5%. On a price return, it's down minus 7%. The JP Morgan seemed to get hit hard and they didn't really seem to recover as good as some other assets. And on the 1 year, we're still up 6% on the 1 year, which is pretty decent. The one thing I will say about JP Morgans is they are very consistent payers and they always will be. They have been for many years. So if you put your money in JEPI and JEPQ, you can always count on getting that monthly dividend no matter what. They have been consistent for many years, which is very good. Next up, we have possibly the worst investment in the portfolio so far, in my personal opinion, which is the MicroStrategy ETP by Yieldmax. And this is nothing to do with Yieldmax. The strategy works fine. It works on a lot of other assets that have been going up. And it's worked for MSTY many years. The total return on this thing's 200+% over the last couple of years. But just recently we've had MSTR take a massive dump, unfortunately. If we look on price, on the 3 month, we're still down 9% on MSTR. So it is single stock risk, unfortunately. And we are down on the 3 month, 13%, and down on the 1 month, 6.5%. So hopefully things are going to start turning around when MSTR goes back up. But sometimes it can happen, but at least we're still getting paid that dividend every single month. If you look on the 7 day, we're actually up 3.5%. So I'm hoping we're going to start seeing some green over the next couple of months for this one. Next up, we have Broadcom ETP, and this one that I think is going to do very well long term. With the new strategy working, as we can see on a price performance, it's up 20% already. That's without any dividends put in. With dividends in, we're up 25%. So I think this one is going to do great long term. I think any underlying that gradually goes up over time, like Amazon, that's why the Mag 7s are in there, Broadcom, just keeps going up over time. I think they're going to do great. And last but not least, we have Silver ETP. So 20.6% on price already. Bear in mind, this has only come out in July, just with the other new ETPs. And the full performance is 24%. And that's with dividends included. So all looking well. We Income Shares new strategy with everything that's gone in here. Guys, please let me know if you like these changes. If you don't like them, I would love to know if you've been an investor in this pie for a while, what kind of total returns have you been getting? Leave me a comment below, guys. And in case you guys missed it, I did an interview with Octave Cavrat, which is the marketing director for Income Shares. Thank you, guys. See you in the next one.